Hello and welcome to another Impact Insights. I'm delighted to have with me today Steve Wood, who is the Specialist Finance Account Manager for InterBay. Hi, Steve.
Good morning, Dale.
Steve, just to go through a few bits. First of all, let's talk about InterBay. Who are they? What do they do? And for a lot of our brokers, they might not have heard of you before.
Okay,
so
sure.
Let's give us an insight.
Cool. InterBay Commercial. We offer commercial, semi-commercial, buy-to-let, HMO and holiday-let products. And as of next week, we're back into the bridging market as well. So unregulated bridging and developer exits. Through commercial and semi-commercial, we can do owner-occupied businesses where they trade from the property, or we can do it as investments. There's no difference in rates or LTVs, so they can have either way. We do interest only through the commercial to help with their sort of cash flows. Buy-to-let and HMO that we focus on is more the complex one. So within the group, InterBay belong to OSB Group, and within that is Kent Reliance and Precise Mortgages. So InterBay's buy-to-let and HMO part is sort of a more specialist approach than Precise and Kent. So Precise would have standard properties, smaller HMOs. Kent would then sort of branch into the more complex, larger, up to about 10-bed HMOs and multi-unit blocks. And then InterBay will do anything over the top, including trading companies. So if they've got an IT company or a cafe business and they're using the profits from that to then diversify into property investment, we can still have it in the trading company. They don't have to be SPVs, they can be layered companies. We're all happy with that in the sort of buy-to-let and HMO space that we offer. Holiday lets have been a bit of a boom of late. Last couple of years, we've been doing staycations.
Sure.
That seems to have gone down quite well. Just standard properties in holiday let locations. Don't have to have holiday let experience, just an existing landlord will still accept them.
Very area specific. You've been doing a lot in Cornwall and Devon.
Indeed, yeah. So we try to focus on those sort of areas. So yeah, Lake District, Cornwall, Devon. Trying to avoid sort of central London flats. Sort of leasehold issues is sort of what we're trying to avoid. But if they want to use Airbnbs, those sort of platforms, and we can use those.
Sure.
But serviced accommodation is more of like a hotel. We'll look at it on that basis, so a commercial basis, and then 2 years experience in running it as such.
Yeah.
But yeah, if it's the first time it's going to be used as a holiday let, we can do an assessment or projection from a holiday let agent rather than sort of has to be let out as such already. So they'll give us an assessment and then we'll work from that. If it's being used as a holiday let already, if they haven't got accounts, then we can use bank statements and bookings just to cross-reference the different time periods. So we look at the high, medium and low season, so get the average from that.
Yeah, sure.
And then work out affordability off from there.
So volume has been good over the last few months.
Indeed, yeah, no, all good. And then, as we build back up towards summer, we should sort of see that demand increase and the pricing is quite good. We can go to 75% on those sort of products.
Sure. And how are you finding valuations at the moment?
Valuations?
Because when the actual valuer is going out to value the property, obviously a lot of people have an idea of what the value of the property is going to be. But obviously we're down to the valuer actually going out and saying what it's going to be and also the rental value that it might be. Yeah. Are you seeing much disparity between what the customer thinks and
no, we do.
What
I mean, it always has been, in fairness, for the last however many years I've been in finance. So the idea of the applicant's view on the property and then when we get it valued. But yeah, there has always been that sort of slight disparity in sort of, you get your extreme examples of come in seriously undervalued, but that's more on the commercial side. On your buy-to-let and HMO, it's all sort of depending on the size and your holiday lets, you just have a normal standard Connells type valuation, which is bricks and mortar comparables. When we get up to sort of the larger 7+ HMOs or blocks of flats, we get investment valuation. So that's on the yields, but again, other properties and blocks that the value has found that show the yields they're achieving and how it sort of compares to the property that's been valued. So yeah, I think sort of more complex properties, and there's different sort of criteria as to how we'll value it. So we always work on vacant possession, particularly on commercial and semi-commercial. So it's very rare that we'll get the true open market investment valuation on commercial, semi-commercial properties because the value attributed to the tenant is not something we look at unless it is someone that's really strong. But at the moment, with all sorts of different businesses going under, it's difficult to see who is that strong tenant. So we favour vacant possession. So that also then brings down values a bit on the commercial side. And then the HMOs, where you get into your larger sizes, we do use just the full investment valuation, so the yield approach. Not the VP of that, the full investment valuation, so we can get a higher figure on those sort of larger blocks.
Okay, so do you see this part of the business, that demand increasing over the next few months is people seem to have quite a lot of money available at the moment, and they're looking at various. They're not looking at standard buy-to-lets anymore, are they? They're looking at other areas of the market.
Indeed, yeah. So semi-commercial seems to be where we've really seen a big boom. That seems to be our bread and butter at the moment. So lots and lots of semi-commercial, where you've got good cover in the residential parts, and you sort of just need to look at someone sort of more like a buy-to-let landlord. So rather than the commercial where you've got to find your tenants, negotiate leases separately per property per tenant, whereas you've got standard resi on an AST, you've got experience in that, you've got your semi-commercial with your flats or whatever it is above, and it's much easier for make that step into a semi-commercial property. Seeing a lot more of that. Usually we've asked for 2 years sort of experience in having that sort of property, but if they're existing buy-to-let landlord, we get more comfort from that, because the residential element sort of helps support the loan, and then you're less concerned about the income from the commercial.
Sure. Okay, so let's take a step back to the buy-to-let side for a second.
Yep.
So you've got to 85% now?
80% through
80, okay.
Yeah.
85% through Kent Reliance?
Yes.
Let's stick with InterBay for a second. So 80%, and what's the sort of maximum number of bedrooms that you'll look at?
We don't have a maximum. So one that I'm looking at the moment is, I think it's 36 rooms, so HMO. Or a block of flats we've got, which is 90 units. So it's sort of a variation of what we'll look at, but we don't have an upper limit. We'll look at as a property, and then when you get up to those more complex properties with a number of units or rooms, then we look for more experience from the applicant themselves. So instead of going from a normal terraced house up to a 50-bed HMO or whatever it is, you want to see that sort of gradual progression up to similar properties, rather than going all in for something they think has got an amazing return, but haven't got the experience of running it. Because to look after a large HMO, keep it up together, all the different tenants, it's quite management intensive. Similarly with a large block, and then service charges, keeping it up together. Maintaining the sort of communal areas, all that sort of thing. It takes a bit more of a professional, in-depth approach and management strategy to keep them up together and occupied, and the rent coming in. So with those more complex ones, looking more at the background, so what their portfolio is like, what sort of properties are in there, what the tenants are like, and then where the property is, they're looking to remortgage or purchase through us. It's what the tenant profile is. Sort of, if it's large HMO, is it near a hospital? Is it serving that sort of, the hospitals, that sort of nurses and that sort of thing? Or is it a student area where there's a good demand for us? That sort of thing to look for, rather than sort of low income sort of tenants, I think, that sort of thing. We were happy with those sort of private individuals, but sort of what that property is going to serve, who's the tenant going to be? So it's going to be an appeal.
So 36 bedrooms is more like a hotel, isn't it?
Yeah, but it's a HMO, so it's sort of, I think the most frequent ones we're getting at the moment are more like student let sort of focused. So yeah, all like super fast broadband, communal areas, more than one kitchen, that sort of thing. But yeah, there seems to be demand for them, and then near hospitals, like I said. But yeah, there is good strong demand, and then some of them are then just the purpose-built student accommodation, which are then sort of cluster flats, which is all within a block. But yeah, you might then, depending on the size of those, look at those on a commercial basis.
And once the bridging bit comes back in, are you looking then at effectively a refurb type scenario at the outset? Then they can sort out the property, get it ready for letting out, and then transfer it onto a term product after
exactly
that.
Yeah, so the homes under the hammer sort of style of properties, buying at auction, it's an absolute wreck. They'll sort it out. If they want to put extensions on, we can do that, do loft conversions, all that sort of thing. Changing the footprint, we're now getting back into, whereas it's sort of through Precise, we've sort of restricted on what we could do. Now coming back into InterBay, we're going to do the non-reg heavy refurb through InterBay. Also doing your standard light refurb through InterBay, but the sort of more in-depth extensions and transforming conversions of properties is what we're going to get through InterBay's route. And then we'll look at the experience of the applicant. So is this what they do? Have they done other projects? Have they got other properties that can show that they've done previous works to? Yes, again, sort of that risk of knocking walls down and extending it. You could make a bit of an issue of what becomes a pile of rubble if you're not careful. So yeah, looking at the applicants, what their experience is. And then also within that, we should do the terming out, so they can do the buy-to-let loan, but there's yet to be seen whether that be, if it's going to be a standard buy-to-let, it can go through Precise or Kent and InterBay. So I think with the choice of where they want to go. We will have a product which will probably go to buy-to-let and then straight onto a buy-to-let loan, to the refurb to term that they have in Precise. But I think for the first launch, I don't think that's going to be there. Similarly with commercial and semi-commercial bridging, that will come in phase 2 for InterBay. So all we'll be focusing on is light refurb, heavy refurb, where they're doing extensions, and then developer exit. So the developer exit is slightly different in that Developer obviously has built block of flats or a estate, a development. Will come in and finance the bit between practical completion and sale. So our rate will be less than development finance. They can clear off the development finance, start selling, and then after a certain point, we get down to 50% LTV. I think when we start sharing the profit, so then the pay down's shared. But yeah, it gives them cheaper finance to then get through the sales period for the development.
Okay, that's really cool. What we're also seeing at the moment, obviously, is the around the corner, we've got the EPC rules and regulations coming in. Obviously, you've got a lot of landlords on your books.
Indeed.
Who is ready? Who is panicking?
Yeah, there are many.
Really?
Yeah. So we've got within our books sort of some quite large portfolio loans. So, several properties. The maximum we've got at the moment is 438 properties on one loan. So we sort of do annual reviews with those sort of landlords just to see how they're doing and anything we can do. But a lot of them then talk about the EPCs and actually looking at the properties, what they can do to get the EPC ratings up. Is it cost effective?
Yeah.
And then some of the ones that are not, or we just think now's the time to get rid of them before you can't let them at all.
Sure.
So there is a lot of focus on it, and something that internally we look at is what is the EPC rating now? And then when it changes to D, is that property going to be okay? What sort of works will be required to get their rating up? So if it's, I think within the EPC guide, you get a grading of what works can be done to improve the rating. So we look at those. If it's minor costs, then we'll look at it and say, okay, that's fair enough. In the sort of normal course of maintenance and upkeep of a property, we should be able to do that and meet the requirements that are coming in. If they're quite, severe works or intrusive works, then we'll sort of then look to see whether we want to do it as a refurb or whether we want to do it as a retention, just to make sure the work gets done.
Yeah. Okay. I think there's going to be a lot of panicking before
Indeed.
2025, and a lot of tradesmen that are going to be very, very busy.
Very happy with themselves too. I'm
very happy. Charging very nice costings as well.
Indeed.
So we've talked about HMOs. Once people actually get on the ladder, it's pretty simple, but actually getting onto the ladder in the first place on the HMO side tends to be, people look for experience and so on. What sort of advice can you give people, brokers, clients right now to start looking at those sorts of scenarios? Because also the buy-to-let side is going to be pretty restrictive, depending on area, especially in the south at the moment. The yields are pretty low, but obviously HMOs are pretty high. So what sort of advice can you give to people to get onto those sort of the specialist side, I would say?
Looking at the properties and what they serve, who they serve, what sort of tenants you're going to have in, whether you could use an agent to help run the property, manage and run the property for you for the initial couple of years, get the tenants in, the cycles of what's happening, how often the tenants change, what maintenance is required. If you haven't got HMO before, then what the license requirements are, make sure the property's got everything that it needs, doing the fit and proper test to hold a HMO license. But then essentially not get blinded by the yield, but look at the property. How good is it? I mean, if you're going in there and it just sort of it's pretty tatty and worn and tired, that sort of suggests that that's the person it might attract. So you might not have a stable sort of tenant profile in there, sort of lots of changeovers. Which then I think the quality of the property and how it's been managed, and then are they prepared to take that step for a bit more management intensive property that comes with the multiple rooms and tenants.
Sure. And then the next level after that would be things like Airbnbs and holiday lets and do you say service accommodation you're looking at?
Service accommodation will do more along the lines of a hotel sort of arrangement, so commercial.
Okay.
And then we would look for 2 years sort of experience in running it in that sort of way. Holiday lets, I think it's a bit more an easier route. We'll look at a standard property rather than something complex like a 23-bed HMO.
Yeah.
So then there is just a ready market for an owner-occupier basis. So holiday lets were slightly different. We do Airbnb on those, but through our HMO buy-to-let route, we wouldn't let them do Airbnb. We want sort of the standard AST lettings. Service accommodation is like a nightly rate, so there's no certainty of income coming from that. So we get a bit nervous, and that's why we look for the 2 years experience from it.
Okay, so let's move on to more the semi-commercial and commercial routes. You're saying you don't do a split of value between the residential and commercial elements? Yeah,
so for semi-commercial properties, if you've got one commercial unit and one residential unit, we'll do it as semi-commercial. If you've got 9 commercial units and 1 residential, we'll do it as semi-commercial, or vice versa. So we don't have a split in value.
Yeah,
it can be 90% commercial and 10% residential. We'll still do it. Okay. So I think that's one of the areas, particularly for InterBay, where we don't have that sort of requirement. So if you say it's semi-commercial, you go to valuation, you haven't got to worry about then it coming back and saying, well, it's 49% residential. So it is just what it is kind of thing. We're happy with it up front. We look at it. As long as you've got a combination of one resi and one commercial, we're happy to do it.
Not worried about what the commercial is?
Depending on what cover we get for the residential part. So if you've got more than one flat above, you usually get good cover from that. So what you'll get from the resi will cover the whole loan amount. Sort of the ICR requirements, 125%. We do need the commercial unit occupied, but if you've got good cover in the resi, not too fussed about what's happening with it. So it's got to be occupied. Our standard requirement would be at least 12 months left on the lease. So if you've got less than that, or they've only just moved in, then we could look at the resi to help sort of support the loan on its own.
Yeah. Okay. And you'll also look at those who might have had some assistance during the COVID period, so bounce back loans.
Yeah.
And stuff.
So we can accept bounce back loans, which can't use it for deposit.
Okay.
When we're looking at owner occupied businesses, mainly it's then looking at the previous year's accounts to show turnover was of whatever it was pre-COVID, and then with the bounce back loan, it's kind of brought it back up to where it was.
Yeah.
So if we're not showing any sort of dip, so their net profits remain as they are, sort of pretty stable with the bounce back loan, then we'll say, no, that's sort of keeping it in line with previous years. But then if you've got losses, and now suddenly profitable because of the bounce back loan, that's not something we'd be happy to do.
Okay. And you're happy for the loans to go into a trading company name?
Absolutely. Yeah. So through buy-to-let, HMO commercial, semi-commercial, we can do trading companies. So don't have to be an opco. Yeah. So the property company holding the property, and then the trading business then operates from it and then pays rent to the property company. We don't have to have that, but if they want to, we can do that. If it's just their IT company occupying, trading and buying in their name, we can do that also. So true owner occupier type deals.
Okay. And multi-layered companies, so one company with shareholding in another
group
one,
of companies, subsidiaries. Yeah. So what we'll need to do is sort of trace back the ownership throughout, and then know that who we're lending to is the ultimate owner. Okay.
And what about if shareholders live out of the UK?
It's not something we're happy with at the moment.
That's fine.
We were sort of pre-COVID, but then we've gone back into that.
So I was thinking the case I've got in the background of my head right at the moment as we're talking, but there we go. What else? So trading business, semi-commercials, HMOs, buy-to-lets, etc. Obviously, are you doing AVMs at the moment as well, or?
We do through Precise, but not InterBay. Okay. Because I think the properties and loans that we're doing through InterBay won't sort of suit the AVMs anyway. So we're doing light refurb and heavy refurb. So we can't do the AVMs on them. There's a lot of work going on with the AVMs in the background, because I think the way that the data is drawn from, it gets more and more accurate, more and more comfortable with them. Yeah. So I think sort of as things progress, we'll see more and more AVMs being the norm on more and more properties. But when it'll ever come for commercial and semi-commercial, I don't know.
No, fair enough. And from our own personal point of view, obviously we've got InterBay that come into our office, and therefore we could do effectively a good conversation as to a reason why to do that case, a manual assessment, a manual conversation with Steve, and that's a good thing for everybody right now, because yes, tech is taking over a lot of our lives, but actually we still need a human decision on some instances, especially when we're involved in complex properties and stuff as well. And talking to tech, where are you at with InterBay at the moment, with moving forward with strides of technology? And
we are due a new system. So at the moment, ours is no automation. It's all manual input and manual assessment. So we are looking at a new system for us. So when that will come, I'm not sure what will involve, but the other parts of the group use DPR, which is a sort of tried and tested product. But we will be pushing forward for a new system. Whether we'd adopt the same as the rest of the group, it'd make things easier to then cascade cases through the different brands. Then you could just sort of, it doesn't fit in Precise, doesn't fit in Kent, it'll go through InterBay. So it's, the potential is you'd apply for OSB and then it'd filter down to wherever it fits best. I think that's the long-term goal.
Be a nice instance, if it ever got there.
Yeah, indeed. Yeah, it'd be nice if we got there. So you just apply and then it would come out wherever it's best suited.
Sure. Okay, I'm just conscious of the time. What else should our listeners or our viewers know about InterBay from your point of view, do you think?
I think it is the manual underwriting side for us at the moment is the key for us, as we're able to look at the cases individually. So what are the merits of the case? Ultimately, if there's something wrong, how can we balance it out? That's kind of our approach to it. So if we find an issue, can we sort of mitigate it somehow? So it could be anything. So planning or something that's not right. Have they got experience to get it sorted or something? Is there an LTV point where we're comfortable with the risk, that sort of things to help sort of balance it out rather than just the computer says no. So technology is good, particularly Google Street View has been amazing for anyone sort of in the lending world. You can actually see the property because, you know, a picture paints 1,000 words. You can actually go and look at it, see what's around it, see what style of property it is, how it's been kept, you know, and then you've got the timelines you can click on. So 2021, you can go back in time to see what it's been like and what the different uses of it have been. So I think that's been really helpful, sort of underwriting and lending wise. You actually see the property before you make any sort of decision, so you can, you know, hopefully filter out the ones you can't do from the outset.
Yeah, I think that's good. I think that's a really good valid point, because a lot of people we get on the packaging side, we get a lot of people saying, please you underwrite the case first before you spend my valuation fee. And obviously they can see the property right from the outset and you've got a good idea that you're going to do that property. Yeah, it's really helpful. It is really good. Yeah, no, it's been the best thing I think, Google Street View. So, yeah, absolutely. And what do you see for 2022? How else do you see the rest of the year progressing for InterBay? So for InterBay, yeah, getting back into the bridging side, getting back into developer exit, and you know, before COVID we were pushing on £1 billion just through InterBay, so we want to get back up to those sort of levels. So, and through that was, you know, everything including bridging. So I think for the rest of this year be pushing on bridging, getting commercial and semi-commercial back to where it was. It's doing very well at the moment, back up 75% LTV on those, and then buy-to-let and HMO. The complex large HMOs don't come around often, so just the focus is commercial, semi-commercial, but we've got that ability to look at those large size HMOs and blocks of flats. Sure. Brilliant. I think that's just about our time. So thank you very much for watching. Obviously, like I said, InterBay are Impact are one of the approved packages to deal with InterBay, and Steve comes into our office a number of times during the month, and we can have sensible conversations about doing those deals. So if you've got anything that's complex and you think there's a reason why to do it, then obviously give us a shout. So thank you for watching this. There'll be more coming soon. In the meantime, stay well and keep safe. Thanks very much. Thank you, Steve. Thank you. Cheers.